Okay, looks like we have people coming in. Good afternoon, everyone. My name is Chase Newsom. I am a co-chair on the CLE committee, and I'm an associate at Brooker Law. It's my privilege to introduce Mark Melton to you today. Most of you know or have heard of Mark, but for those of you who may not know him, Mark is a partner at Hall & Knight, and he works in their transactional M&A division. Mark advises hedge funds and private equity groups on the tax implications of domestic and international financial ventures. He's a rare breed because he has his JD as well as his CPA, so he is eminently qualified to talk to us today about evaluating and reading financial statements. There's a Q&A feature at the bottom of your screen. If you do have a question, submit your question and we'll try to answer as many of those as we can at the end of the presentation. Sherry Harris is also assisting us today. She's going to post the CLE course number in the chat. So make sure you monitor the chat and copy the course number down so you can get credit. I want to thank each and every one of you for attending today. And again, I want to thank Mark. Speakers like Mark are what differentiates DAYL from other young lawyer associations throughout the nation. So without any further delay, I'll turn it over to Mark.
Great. Well, thanks for having me, Chase. Always good to be here and talk about accounting, one of my favorite topics, as I'm sure it is yours as well. So let's jump in here. Now, what we're going to really talk about today is pretty basic accounting 101 kind of concepts, just so that you have some idea of how to read a financial statement. You clearly will not be an expert by the end of this 1 hour CLE, but hopefully you'll have some context for why things look the way they do and how they got there. All right. So first of all, you've probably seen generally accepted accounting principles and documents that you've worked on, or GAAP, which is basically just a set of rules that accountants or companies, in fact, are held to. It's kind of like the law of accounting. And in fact, in a lot of ways, it is a law because this is ultimately regulated by the Securities and Exchange Commission for publicly traded companies. And so they set a lot of these standards through SEC regulatory guidance. But the main promulgator of the accounting rules is something called FASB, the Financial Accounting Standards Board, which sets the rules. And there's a code, just like there is in many areas of the law, and it has a series of rules and for various situations on how you're to account for things. And you're supposed to follow these things if you are a publicly traded company. Now, for private companies, it's a little bit different because a lot of the requirements to account for things in a certain way are contractual. And so maybe your lender will require you to be a GAAP basis accounting system, or you may want to do it anyway, just so that in your dealings with vendors, or if you're going to do some kind of merger and acquisition transaction, it's easier for someone to come in and look at your books and confirm that they make sense and that what we think it means is what it really means. But not all companies are GAAP compliant. There are a lot of companies out there that are intentionally not GAAP compliant because they don't think they need the complexity or it doesn't suit their business model. One notable example is car dealerships, who have a crazy, completely different set of accounting, but the concepts are similar. It's just how it gets reported at the end of the day. But there are lots of examples like that of specific industries that are not necessarily GAAP consistent in the general sense, but have some variations, and that's fine. So you'll see a lot of times in purchase and sale agreements, or even loan agreements, that there'll be representations that the company either maintains their books on a GAAP compliant basis, or that they maintain their books on a GAAP compliant basis with whatever listed exceptions are in disclosure schedules and things like that, so that people understand what they're looking at and they can compare one company to another. Because if company A is using one set of rules for accounting, company B is using a different one, those are not easily comparable. So let's just start with the basics, the accounting equation, which is assets equals liabilities plus equity. And so you'll notice on every balance sheet, there are three primary sections: the asset section, the liability section, and the equity section. And if you simplify this and just think of it in terms of what you probably in common parlance have referred to as, the value of a home and equity in a home, the value of the home minus the debt that you owe the bank, right? People commonly refer to that as I've got that equity in my home. And so if the home value is $500,000 and you owe the bank 400, right, you might say, I owe, or I've got $100,000 of equity in my house. Now I originally gave this back in 2009 and 10, I think was when we first did this. And so since then, I do understand the irony of talking about home ownership in this modern day and age for young people. So hopefully you guys will not suffer some of the same consequences that a lot of young people are, and will make it out and get a home and be able to say that you've got equity in a home at some point soon, if you don't already. I highly recommend it, by the way, because even if you're paying a little bit of a premium, it turns out 30 years from now, your mortgage payment is exactly the same as it is today, and your rent will be 50 times more than it is today. So it's a good financial move, no matter what anybody else tells you. So there's your financial lesson of the day. All right. Accounting information is reported on a few different types of forms: the balance sheet, the income statement, and then a statement of cash flows. And so we're going to start with the balance sheet. That's the most important one because it is a picture of where you're at today as a company. And so we're going to step through just some very simplified examples just to hopefully help you understand how this is really working in the background. Obviously, it should make sense to most people that if I see an asset that says I've got X dollars of assets and then I've got Y dollars of liabilities, with some description, most people kind of get that. But let's get into some of the mechanics of how things move around on a balance sheet. So in this hypothetical, you're intending to buy real property for $500,000. Say the example is above, the bank's going to loan you $400,000, and you're going to put up $100,000 in cash to make up the difference to buy this house or a rental property or whatever it is that you're buying. And so your first step is you're going to capitalize your new company with $100,000 in cash. And so you'll see down here at the bottom on this date when we did this deal in December 30th of 2010, that we've now got cash in the company of $100,000. There's no debt yet. We haven't borrowed any money. And the equity section is $100,000 as well. It's the investment in the company by the owner. Now you'll notice here, we go back to that accounting equation, right? Assets always equal liabilities plus equity. So if you think about a balance sheet in terms of assets being on the left and liabilities and equity being on the right, which is not always how it's presented. Sometimes it's just down the page. But think about it this way. This total assets number will always equal total liabilities plus equity. So the left side of the page and the right side of the page always have to have the same sum at the bottom. And so far, this makes sense. We only had one transaction. We deposited $100,000 in the bank account, and that represents my investment into the company as an equity owner. Excuse me. All right, in step two, we acquire the property. And so we go out to the bank, they loan us the $400,000, and then we close. And now, if we look at our balance sheet, it should make sense. We no longer have any cash because we spent it, but we do have $500,000 worth of real estate. So our asset section shows that $500,000 worth of real estate. We also now owe the bank $400,000. So our liability section shows that $400,000 liability. And then obviously we still have our $100,000 of equity in the business because we wrote the check to put it in there. And so on day two of our little business here, this is what our balance sheet would look like. The thing to remember though is things on balance sheets don't just magic themselves from that into that, right? There has to be some mechanic for making that turn into that. And so let's go to the journal entries, which are what we call the entries into the system that actually put something into an account that shows up on a balance sheet or an income statement. Now, people often think that the word debit means minus And the word credit means plus, and that's because your bank, you look at your personal bank account, right? You think of things in terms of credits and debits, right? I've got a debit card, and when I use it, it reduces the amount of money in my bank account. Well, debit does not mean minus, neither does credit mean plus. Debit just means left, and credit means right. And so again, back to our balance sheet, where if we're thinking about this in terms of assets are on the left, that means if we are going to put something that is a positive into an asset account, it's a debit. Debit's going to do that. And then there is also a credit that is going to happen somewhere in this system. But if I want to increase a liability or an equity account, I'm going to credit it. Debits always must equal credits in any particular journal entry. That's the only way that the balance sheet ends up balancing at the end of the day, where assets do in fact equal liabilities plus equity. So here, in our first transaction with the cash, so I wrote the check for $100,000. Now keep in mind, we're thinking about this in terms of the company, right? Not in terms of me as the investor. This is not my balance sheet. This is the company's balance sheet. And so from the company's perspective, it just acquired $100,000 in cash. And so to increase that cash account, which is an asset account on the left side of the balance sheet, I'm going to debit the $100,000. And then I'm going to credit investment by owner, which was, as you recall, in the equity section of the balance sheet. And that one entry right there is how we got here. There's the $100,000 debit. There's the $100,000 credit. All right, now on the second transaction where we borrowed the money and we acquired the property, we have $100,000 sitting in this cash account, right? It doesn't just evaporate because we buy a piece of property. We have to actually now credit that account to take it back to zero. Otherwise, it would still show $100,000 on the asset section of the balance sheet. So if you think about this, everyone gets so confused about what's the debit and what's the credit. But if you think, all right, well, what do I have? Right, I have a piece of real property. I have a liability for $400,000. So it's easy to figure out just through common sense and logic what this balance sheet should look like, because it should look like that. It's intuitive. So to get from that to that, what do I need? Well, I clearly need a debit in the real estate account of $500,000 to get that there. I need to get rid of this cash. So that's clearly a credit of $100,000, because remember, this is a debit positive account. So if I want to subtract from it, I'm actually going to credit my cash account, and that makes my cash balance go backwards or down. So if I do that, that takes that to zero and gets rid of it. And then obviously I need to show that I owe the bank $400,000. So that's a credit of $400,000. And so when we go to our journal entry, you can see it right here. Debit of $500,000 into the real estate account to put it on the balance sheet. We're going to credit the cash because we got rid of it. We no longer have that cash. And then we also are crediting our liability account for $400,000. And you'll note that those equal 500,000, 500,000, right? 100,000, 100,000. They always equal the sum of the debits and the sum of the credits. Now you might be thinking, well, why in the hell does Bank of America do this in reverse? Why does my personal bank account go down when it's debited and it goes up when it's credited? And that's a good question. The reason is because you're looking at the bank's accounting on your account, not yours. And from the bank's perspective, when you put $100,000 into your bank account, that's not the bank's money, it's your money, which means they owe it back to you. You basically loaned your bank $100,000, usually on an interest-free basis, and they hold it for you in an account, which means to them, it's a liability, right? They would show a $100,000 liability for deposits owed to Mark Melton. So since it's a liability on their books, you credit a liability to make it bigger, right? Because the more money you put into that account, the more they owe you back. So that credit is making their liability bigger. And as you take money out of that, you're basically taking demand payments on your loan to the bank as you spend it. And so that debit decreases the liability on the bank's balance sheet. And so it shows up in reverse in the way people think about debits and credits, because they're not talking about your bank's or your balance sheet, but they're talking about the bank's balance sheet. All right. So let's keep going with our example here. So in the following year, your ABC real estate company earns $50,000 in rent, and it spends $40,000 in interest expense, property taxes, and maintenance costs. So the net income, 50,000 minus 40 is 10, obviously. But we want to know more than just the net income amount, right? Because we want to be able to manage our business. So we'll get into the income statement here in a second to show the detail behind that. But again, these are pretty simple examples. So hopefully this makes sense. We've got a $10,000 increase in the assets of the business, right? We have brought in $50,000 in rent income, and we have spent $40,000 of it to maintain the business. And so, whereas before this was our balance sheet, we had $500,000 worth of stuff in the company. Now we have $510,000 worth of stuff in the company. And in this case, that stuff is represented by cash because rent got paid in cash. We spent some of it. We got 10 grand left. Okay, so now our balance sheet should show that we have $10,000 in cash, $500,000 in real estate. We still owe the bank 400 grand. And so to make this balance on the left side and the right side, well, we need to show who owns these assets. Is it the bank or is it the owners of the company? And that's really why we have this separation of liabilities versus equity, and why it always equals assets is because it's just segregating out those assets to show who technically owns them in a liquidation scenario. And so here, if we were to liquidate at $510,000, the bank would get 400 grand and everything else would go to the owner, you, right? And so we throw the earnings of the business into the equity section, into an account called retained earnings. And retained earnings, by the way, is exactly what it sounds like. It's the retained earnings of the business. So if we were to make a distribution out of the company to ourselves, for whatever reason, that would go down, right? Because it's no longer earnings that are retained in the business. We have distributed them and they're gone. So if we wrote ourselves a $10,000 check, again, this is very intuitive. There now is a zero balance in the checking account. So that should be zero. And there is no more retained earnings in the business. So that should be zero. So we would have debits and credits between those two accounts to zero them out to show the distribution to the owner. So again, sometimes it's kind of intuitive if you think about, if you're just looking across all the assets and liabilities of a business, you kind of know what it should look like. And eventually, when you look at these things enough, the same is true in reverse. When you look at these financial statements, you kind of have an expectation of what you should be finding when you go out into the world and look at the actual businesses. Now, the income statement is different than the balance sheet. Remember, a balance sheet, although it changes with each entry, is a snapshot in time. It's showing you, as of this particular moment in time, here are the assets that you own, and here's what you owe to other people, and therefore here's what you own on an equity basis. An income statement, on the other hand, shows activity over a period of time. And so typically you would think about these in terms of, annual income statements or quarterly or monthly, but it's going to show you all of the activity that happened throughout that period of time that eventually is going to feed back into your balance sheet to true it all up. So here in our same example, recall we had $50,000 of rent income, and we had $40,000 of various expenses to maintain the property. And so our net income was the $10,000. It made sense on the balance sheet that we would then have $10,000 of cash and $10,000 of retained earnings in the business. But if someone wanted to see, well, how did you get to that $10,000 of retained earnings? They would want to look at the income statement, which is going to provide the detail over that period for how the number changed in retained earnings. In this case, it went from 0 to 10,000. But next year, if it was undistributed, maybe it goes from 10,000 to 20,000, right? Or 10,000 to 100,000, who knows? But the income statement is going to tell us what happened in that interim period that explains the change in the amount of retained earnings that are in the business. And so here you can see we've got revenue showing up at 50,000 in the form of rent income. And then we're going to list expenses, interest expense of 29,000, property taxes, and then some repairs for a total of 40,000, leaving us with net income during this period of 10,000. Now, if I wanted to look at what explains retained earnings over the life of a business, I would have to pull the income statements from each period and add them all up. And they would, in theory, equal what's in retained earnings, with the exception that I would have to also look at how much of these earnings have been distributed over that period of time. But it should be the total of my income statement, net income, minus any amounts that have been taken out of the company through distributions, and that's what my retained earnings should equal. Keep in mind that sometimes retained earnings can also be a negative number. So if I go earn or invest a bunch of money and then lose it all, it shows up as negative retained earnings. It doesn't ever say retained losses, but it's effectively what it is. But let's move along here. All right, so the balance sheet. We've got our debits, again, increasing assets and expenses. And this is what I want to focus on here on this slide, is we've already talked about that debits are going to increase assets. And debit, again, meaning left, is going to be a plus in an account that is on the left, right, which is just assets. And then a credit is going to be a plus on accounts that are on the right, which is liabilities and equity. Okay. Now, if I want to have a subtraction from something that's over here, all right, then I'm going to credit it because that's a right side entry on the left side of the balance sheet, right, which is going to make that number smaller and vice versa. All right, now keep in mind, again, whatever's on the income statement is being reported cumulatively right here in retained earnings. And so when I think about revenue and expense accounts, they are kind of sub accounts of an equity account, right? So they are the two things that make up the retained earnings account, right, excluding dividends. And so if revenue is going to make earnings bigger, which that should just make common sense, and expenses are going to make earnings smaller, and this is ultimately an account that is really sitting on the right side of my balance sheet, even though it's showing up for periods of time on a completely different financial statement. Think about it in terms of the balance sheet. Revenues are going to be credit accounts. They're going to get bigger by crediting a revenue account because it's a subset of an equity account, which is on the right side of the balance sheet. And then expenses are going to decrease that right side balance sheet account through a debit. So that is going to be the minus because it is decreasing an account sitting on the right side or the credit side of the balance sheet. All right, so we've got 5 accounts. That's really it. It's just assets, liabilities, and equity, and then revenue and expense, which are really just a subset of equity. And so if you're ever going to do journal entries, you've got to kind of keep that straight in your head. Which ones go up with a debit and down with credit and vice versa. Now you might be thinking to yourself, I'm a lawyer. I didn't go to school for accounting. And why do I care? And the reason is, especially if you're a transactional lawyer, especially for both, if you're a transactional lawyer, oftentimes your clients will want to understand just the basics of what's going to happen here on my financial statements. And it's always helpful. It's not required. It's perfectly okay to say you need to call your accountant about that and have them advise you. But it certainly is a whole lot more valuable to your client if you at least understand what that accountant is telling you, right? Because you've got to translate all these concepts into documents in a merger and acquisition transaction or any other kind of contract, which I'm sure that you guys have seen in a lot of contracts. There are accounting concepts, whether it's a net working capital adjustment, which we'll get into a little bit here towards the end, or some kind of net revenue royalty, or all kinds of things where you really need to understand, well, what does that mean, right? How are we arriving at net income for purposes of determining what my my rent might be, or whatever else that you're looking at. So they are important concepts to understand. So I'm glad you are here listening. All right, so again, summarize the types of financial statements. We've got balance sheets, income statements, and statements of cash flow. The balance sheet is a snapshot. The other two are over a period of time. Income statement obviously is showing you usually on an accrual basis, but not always, whether or which revenues and expenses were over a period of time. Statement of cash flow just converts that into actual cash movements so that you can see. I put a statement of cash flows in. I did. Okay, we'll come back to that in just a second. Looks like in a couple slides. But this one helps you see how cash is moving in your business, because again, oftentimes businesses are using accrual basis accounting for income statements. So let's talk about cash method accounting versus accrual method of accounting. So far in the examples that we've looked at, we've just used kind of a cash method. When we wrote the check to the company, we recorded it. When we collected the rent from the tenant, we recorded it when the cash came in. We paid the taxes. We recorded it when the tax got paid. But keep in mind, and property taxes is a good example, they don't just come up at one time, right? That is a tax that is paying tax over a period, usually a year, right? And so maybe the tax is due in May, but it really was for the period, from June of last year through May of this year, or June of this year through May of next year. But just because you're writing the check now doesn't necessarily mean that it's an expense related with this month's business activities, right? You could be prepaying an expense that's covering you across several periods into the future or back into the past, which is why we use accrual method accounting in most cases. It's a little bit more complicated because then we got to think about I'm writing the check now or I'm accruing expense now, but the cash payment is not necessarily matching up with the period of time that I'm using that asset or expenditure. So a perfect example here is, and put it in here as prepaid insurance. So again, let's say that we acquire an insurance policy and it's going to cost us $1,200 for the year. And we'll just do this one simple and say we did it on January 1st. If we just book that $1,200 on January 1st as a cash method expense, right, we would just credit cash for $1,000 or for $1,200 rather, to reduce our cash account by the $1,200, and then we would debit insurance expense. Now the problem with that is did we really have $1,200 worth of insurance expense in January? And the answer is no. We're really only using $100 worth of that premium expense in January, because another $100 is getting used in February and another in March and another in April and so on and so forth. And so what the accrual method of accounting tries to do is match expenses with the actual period in which they're being used to generate revenue, so that our revenue and our expenses are showing up on the same income statement, so we can truly compare on a month-to-month basis how we're doing. Because if I just have random $1,200 expenses in January that don't show up in any other month, is that really a fair comparison of January's net income versus February or March? Obviously, the answer is no. So the way we would do that is when we write the check on January 1st, at that point, we haven't technically used any of it, right? We still have, even on January 1st, 31 days of coverage that hasn't happened yet. So on the first of the month, we would just credit cash for the $1,200. And instead of debiting insurance expense, we would debit something called prepaid insurance, which is an asset account, because it's an asset that I've paid for that I'm going to use into the future for the next 12 months. And then at the end of each month, I would go in and I would credit that prepaid asset account, which would, keep in mind, as an asset, so that's a minus on the prepaid insurance. As I'm using it up, that balance on the balance sheet is going down from $1,200 to $1,100 to $1,000 to $900. And the other side of that entry is now I'm recording a debit on the insurance expense. So I'm expensing that month to month as I'm using it up. And so if I looked at my income statements for each month of the year, it would show $100 of insurance expense for each month, right? Which is theoretically accurate and allows me to compare my performance as a business on a month-to-month basis without these kind of skewed one-off expenses that really are benefiting me across multiple periods. Now, the statement of cash flows is a weird one, and it's broken into three different sections, and it confuses people because the language that is used in it is not as intuitive as some of the other things. And so we've got cash flows from operations, cash flows from investing, and then cash flows from financing. Now, cash flows from operations, that one's pretty much what you think it is, right? It's how much cash should I generate in and out from the actual operation of my business. In our prior example, that might be the $50,000 of rent income minus the expenses of $40,000, right? We show $10,000 of cash flows from operations. But cash flows from investing would show CapEx type expenses. So when we bought the real property, that section of the cash flow statement would show an outward or negative $500,000 number because we actually wrote a check for $500,000 to buy the property. Now, part of that was debt, recall, right? We put $100,000 of cash in, we borrowed $400,000 from the bank. And so the cash flow from financing is going to actually show positive $100,000 because this is going to reflect cash that came into the business from either our lenders or our equity owners. So it would show a positive $100,000 from your investment of cash, and it would show a positive $400,000 from the loan into the company from the bank. Now, as those things are paid down, as you're paying off the loans, right, you would show negative amounts in the financing section of a cash flow statement, because that's really has nothing to do with your operations. The fact that you're paying principal on a loan, because we want to isolate what are our cash flows from operations as if we had no CapEx expense and we had no lenders or equity owners that we had to really worry about paying, just what's the cash from the business itself. And so that's why we're segregating out cash flows from investing, which, by the way, not only includes a negative for a purchase, but if we went out and sold that piece of real property for $700,000, we would show that $700,000 of cash as a cash flow from investing. Because again, that's not really our business. Our business is renting it out. And so we want to keep those cash flows isolated. And so the fact that we've got $700,000 of cash coming in, even though on a $500,000 investment, that $700,000 is going to show up in cash flows from investing, so that we know, what was really just from appreciation or investment versus what was from the actual operation of our business. All right, now within the balance sheet, you're going to see a lot of kind of broad categories. I'm sure you've heard the term current assets and current liabilities, especially in the context of discussions around net working capital. And if you're a transactional lawyer in an M&A transaction, for sure, it's always going to see some kind of net working capital concept. And even for the litigators in the room, people are suing each other all the time over net working capital calculations. And usually it's because the lawyers who wrote the contracts didn't really understand what net working capital even meant. And so it's drafted so ambiguously that there's plenty of things to fight about to keep you litigators busy. So let's try and actually understand a little bit more about what these words mean. So current assets, or sometimes referred to as liquid assets, are assets that include cash and other things that generally can be converted into cash easily within the period of 1 year. Now, that doesn't mean it would take you a year to sell something if you try to do it today, but if you think about inventory, I might have enough inventory in my store that it just takes me a year to sell through all of it, even though I'm constantly replacing that inventory throughout the year. But there's a turnover period of a year or less usually on inventory, and so that typically counts. Accounts receivable, right? Unless you're a bank making long-term loans, usually your accounts receivable are due within 30, 60, or 90 days. And so the fact that you have an accounts receivable is typically going to convert to cash in relatively short order. So that is a current asset. Obviously, to the extent you have marketable securities, meaning publicly traded stocks and bonds that you can go to your broker right now and sell them. If you can convert those to cash quickly, then they're going to be current assets. And so generally speaking, these are the categories. It usually is cash and cash equivalents, meaning marketable securities, inventory, and accounts receivable are going to be the totality of what is in current assets. Now, if you're looking at some of these bigger companies, they'll have a whole lot of other things that might fall into the cash equivalents section, right? Which could include hedging programs on different types of derivatives that they could terminate their positions in short order. You can have crypto is something that we're starting to see a lot of that's sitting in a current asset account because it can be converted to US dollars quickly, at least in theory. So everything outside of that, though, outside of those current assets, which really represents this is the amount of cash that I should easily be able to get to satisfy any of my obligations within the next 12 months, is what I'm looking at for current assets. Outside of that, we have fixed assets, which represents kind of tangible assets that are not going to generally convert to cash within 1 year. So these will be fixed assets like the computers and desks and trucks and shelving and buildings and things that you can touch that you're not really planning to sell. They're not sitting there ready to be converted to cash. You plan on using these things in your business over the long run. And then finally, intangible assets, which is all the things that you own that you can't touch, like a patent or goodwill or trademarks. So those things could also show up on a balance sheet as an asset, usually when they're acquired. In most cases, if you're self-created intangibles, you're just expensing the cost of creating them along the way. And so most companies will not have a whole lot of intangible assets, even though they might own a patent or a trademark that's very valuable. It's not always going to show up on the balance sheet. Because again, keep in mind that these balance sheets also, is another important point, are based on historical costs. So we're showing the actual amount that we purchased an asset for. We're not adjusting it in most cases in the event that asset becomes more valuable. So if I go buy a piece of property for $500,000, it in a year or two is worth $1 million. I'm not making any changes to my balance sheet to show that I really have an asset worth $1 million. It's still sitting there on the balance sheet at my cost of $500,000. So don't assume that the numbers that are on a balance sheet equate to the value of the assets that are being reported there. These are just the historical costs and how we're using them. On the liability side, we've got kind of same thing, really, current liabilities and then long-term liabilities, with current liabilities being any amounts that are due in the next 12 months. Now that could be the things you would typically think of in accounts payable, payroll payable, taxes payable within the next 12 months. It also includes the portion of any long-term debt that is payable in the next 12 months. So I might owe $100,000 in a term loan, and based on the amortization schedule, I'm going to pay back $10,000 of that principal this year. That $10,000 is going to show up as a current asset, with the other 90 showing up as a long-term asset. Now, there's a question in the chat here about how do you value goodwill on the balance sheet? And the answer is you really don't until there is a disposition of the business. And that could be an acquisition of the business from a purchaser's perspective. And basically what you would do is you value goodwill by looking at the purchase price of all of the assets. And then you assign that purchase price to each of the assets that is in the business. And to the extent that someone has paid more than the value of each individual asset, that excess is the goodwill, right? And this represents the value of the business associated with some other person actually taking all of these assets, putting them together into a process that is generating money. And so this is the classic example of the whole being worth more than the sum of its parts, right? The goodwill is that excess of the value of the whole over the sum of its parts. And so if you were to go out and buy a business for $100 million, and that business had $50 million worth of current assets, fixed assets, and intangibles other than goodwill, you would book that 100 million into each category, and then that excess 50 million you would book as an asset called goodwill. But you only do that when you are purchasing, right? So if I'm the original founder and I've just purchased $50 million of the assets and they're suddenly worth 100, I'm not showing that goodwill on my balance sheet. But if you bought it from me, you would show it on yours, right? Because you actually paid for that goodwill. I'm just benefiting from something I created myself by putting all of these pieces of the puzzle together. So again, it's a good point when you're comparing one company to the other, understanding that the stated amounts on the financial statements aren't necessarily indicative of the actual value of the underlying assets. All right, let's go right back here first. I won't leave this too quickly. Working capital is current assets minus current liabilities. All right, so I'm looking at my cash or assets that are easily converted into cash within 1 year. And I'm comparing that to my current liabilities, which is the amount of cash I'm going to need to come up with in the next 12 months to satisfy my obligations. And so obviously you want the current assets to be more than the current liabilities, because that should give you some comfort that you should have enough cash to satisfy your short-term obligations. And they call that ratio the current ratio, by the way. So if I've got current assets of $100,000 and current liabilities of 10, right? I've got 10 times more current assets than I need to pay off my current liabilities. So my current ratio would be 10 times current liabilities. All right. In the equity section of the balance sheet, right, we have these different sections. One is common stock. And this is, by the way, only in the situation we're talking about a C corporation, corporate entity under state law. It would be different if we were looking at an LLC or a partnership or some kind of non-corporate entity. They would use different language, but the concepts are kind of similar. But in an actual state law corporation, you have common stock, which only reflects the amount paid for at par. And so keep in mind, when you issue stock in Delaware or Texas, you assign a par value to it most of the time. And it's usually very low. So I might issue 100,000 shares of stock in a Delaware corporation with a par value of 1 penny. Now, the par value has nothing to do with the amount of money that I issued the stock in exchange for. It just has to do with I can't make distributions down the road that would deplete my par value below zero in certain circumstances. So people just try and make it as low as possible so it's not restrictive later on their ability to make distributions to themselves. So the common stock reflects only the par value. It's usually a very small number. Now, where you book the rest of the purchase price is additional paid in capital, or APIC. And that's the amount that you paid for the stock in excess of the par value. So if I issue stock with a cumulative par value of $1,000 for $100,000, right, then in my equity section, it would show $1,000 of common stock, $99,000 of additional paid in capital. And really, you can kind of combine those accounts, at least largely. And that's just telling you that investors have paid $100,000 into the company for equity in the business. Retained earnings, we've already talked about. It's the earnings of the business that you have not yet distributed. And then treasury stock is something that you'll see sometimes, usually only in public companies where they have programs where they're buying back their own stock in a public market. And then retaining it, they're not canceling it. So they might reissue it later or give it to an executive or something like that. But it's not terribly important to understand. Now, in a partnership or an LLC context, again, you kind of have these categories of here's what was invested by the business, here's the retained earnings. So they're separate. What's interesting about partnerships, especially, is that whereas in a corporation, everything is just kind of getting thrown into one bucket, and we just kind of are saying that part of it is equity. For partnerships, they typically want to segregate out the amount of the equity section that relates to each individual partner, right? And keep in mind, you can do all kinds of crazy things in partnerships on how you share that money. It doesn't have to be pro rata. And so some of those calculations get a little crazy. But when you hear the terms like capital account in a partnership, All that means is the capital account for a partner is the portion of the equity section of the company's balance sheet that would go to that partner in the event of a liquidating event. And so the sum of all of the capital accounts in a partnership is going to equal the equity section of the whole company. So all that capital account is doing is splitting out the portion of the equity section attributable to each partner. On the income statement, you're going to see obviously things that you always have thought you would see: revenue, which is just gross dollars coming in the door. Cost of goods sold is the amount that it costs you to create that good that you just sold. So if I bought one Twinkie for $1 from the warehouse, and I sold it to a customer for $2, a revenue of $2, I would have cost of goods sold of $1, leaving me with gross margin of $1. And gross margin is just looking at how much money am I creating off the sale of one product based on what that particular product cost me, excluding all my other expenses. Then we have operating expenses, which would be things like rent, light bill, employees, taxes, all the other things that it costs you to run this business. And so that gross margin minus your operating expenses is the net income of the business. So that's whatever's left. Now, these last two are just kind of terms that we use when we want to try and compare businesses without taking into account how much debt services on. We just want to know what's this business generating on a debt-free basis. And so EBIT, earnings before interest and taxes, is basically looking at net income and then backing out any interest expense or tax expense. So we know if there was no debt and there were no taxes, what would this business be generating? And that's usually for comparison purposes from one business to another. And then EBITDA is the same concept, except we're also removing amortization and depreciation expenses, which are not real cash expenses. We might have bought those assets 10 years ago. And so we just want to kind of see what's the business doing. Now, keep in mind, if you're using EBITDA calculations, it's very important that you don't forget when you're doing your planning that you've got to think about CapEx. How much money am I going to need in 5 years to replace a building or a truck or some other asset that's going to waste away to nothing? All right, fair value accounting, which we talked about briefly, which is something you don't normally do, meaning we're not going to adjust the value of our assets on the balance sheet. They're going to stay at historical cost. There are some exceptions to that, primarily in the private equity and hedge fund and mutual fund world. So any type of investment vehicle is generally going to be required to mark its assets to market, at least annually. And the mutual fund and sometimes hedge funds will mark theirs daily so that you can know on a daily basis, especially the publicly traded ones, they kind of have to do this to know what is the trading value of one unit in a mutual fund going to be from a day-to-day basis. But they're literally just looking out there and marking everything to market. So you have income and loss generated not by a trade, but just by the built-in gain or loss that is happening from period to period among the assets. So that would, if you use fair value accounting, at least in theory, would tell you this is the actual value of the business. But again, it's very limited in its use. And there's mortgage securities comment was a huge problem back in 2007 and 8 and 9 when they had to mark them down because of these big losses, which caused all kinds of violations of covenants, which threw a bunch of big financial institutions into bankruptcy. And other investors came in and bought those assets at these deflated values. And sure enough, as expected, they all came back, or at least largely. So if they would have been able to just hold those assets and wait, they probably wouldn't have gotten out of business. So I think with that, we're getting pretty close. I don't think we need to get into deferred tax items. It'll just confuse you, but I will put the slide up there, which if you want to study it is kind of helpful, but I want to leave a few minutes here at the end in case there are questions. Feel free to shoot them out to me. And if not, always feel free to call, write, text, carrier pigeon. We can try and get you answers later too. So Chase, I don't know if you want to take back over, but
Yeah, so Mark, it looks like we do have one question from Candace. Can you talk about the fact that cash and indebtedness is excluded from net working capital in most cases?
Sure. So you got to think about first, let's start with indebtedness, right? Because what we're really trying to do is we're trying to value a business. Actually, I have an entire other presentation just on this topic. But when we're trying to value these businesses, things are changing from the day you sign the agreement until the day you close, which could be months down the road. And so this is really looking at that current liabilities versus long-term liabilities. So when you talk about indebtedness, company indebtedness is usually defined to be limited to the long-term debt of the company, whereas the current liabilities are part of the net working capital adjustment that's in the document already. And so you want to be careful that you're not double counting, that you're not including a particular liability as both a current liability that's affecting your working capital adjustment, and then also affecting your company indebtedness, which is typically going to be paid off at closing, because that's a double count. And then you can have some really weird distortions in your purchase price. So between indebtedness and working capital, that's why. Because you're paying off indebtedness, you're not paying off working capital, but an upward or downward movement in that working capital is going to impact the purchase price. On the cash side, most businesses, actually all businesses, they're initially valued on a cash-free, debt-free basis. So when you're trying to figure out what is a business worth, you assume that on the purchase date that it has absolutely no cash and no debt. And so what would that group of assets be worth if there was no debt or cash, right? And then you add those things back, right? When you're looking at a net equity value, to say the enterprise value is the total value of the assets on a cash-free, debt-free basis. But the equity value might be less or more because either we're sitting on a bunch of debt or we're sitting on a bunch of cash that could be distributed, right? It's just excess cash. And so it's not part of the valuation process.
Awesome. Thank you so much, Mark. Not seeing any other questions. Just to remind everybody who attended, Sherry posted the CLE course credit number in the chat. Make sure you write that down. Just want to thank Mark again for taking some time to come speak with us today. I really do appreciate it. Really do appreciate your time. And we will see everybody at the next event.
All right. Thanks for having me.
Absolutely. Thank you.